Is the stock market your only investment option? Well, it's not, and many of you know that. But the question is, how do you find great off-market investments that are going to complement the market portfolio that you have, or maybe improve or replace the market portfolio you have? You know, this is something that a lot of people thought about, they weren't sure about, they don't know about. And there's been a lot of conversation around this over the years as far as, is the market the only solution? And I got to tell you, when you think about it, if you watch media as a general rule, if you watch CNBC or Fox or Bloomberg or read papers that are out there today, most of them, not all, but most of them, as a general rule of thumb, talk on a regular about the stock market or things connected or collaborated with the stock market. And we got Steve Snowden, advisor in business development, Nick Geraci, our private tax director, joining us today as well. And so, guys, let's talk about this just briefly. We're not going to take long on this, but I do want to step in and take a few minutes on the Invest Well show here and talk about this, because this is something, quite honestly, that a lot of families, investors, they just don't know. They're in the mindset of like, hey, I'm going to diversify, and instead of trying to pick stocks, we're just going to diversify into the S&P or the NASDAQ or the Dow or, whatever it may be. In other words, they're in a place where their mindset is, well, if I just diversify across a basket of stocks, hey, the S&P has averaged X% a year over the last 30 years, and you're going to be okay. The problem is that, as people invest and as they get older, they're in different spaces and different seasons of life. People used to say, well, you invest in the market, and you've probably seen this before. People say, hey, you invest in the market. If you keep in the market and invest in the market over a period of time, you're going to be just fine. And that period of time used to be 10 years, and then it's 15 years, and then it's 20 years. It kind of just keeps getting longer and longer and longer. And so, the reality of it is, for folks that are, let's say, 40, 50, 60, 70, they've built some wealth, they've sold a company, they've retired from a great business, and they have millions of dollars at their disposal or more. They're in a place where they're saying, okay, what should I really do? I mean, a lot of family offices, guys, we've done work and helped with investment offerings and different things for family offices. One of the things that we've seen is they typically are not focused or heavy focused on the market, and they know that. But unfortunately, a lot of times families or investors don't always know that to be the case. So let's talk about this a little bit. Let's unpack this just for a minute, because I think a lot of times, people by default will go there. I would say, I don't know what the exact percentage is, but I would say it's safe to say the majority, maybe 90% or more of advisors in America, financial quote advisors that are giving thoughts and ideas, are typically referring primarily to the investment allocated to, diversified in the stock market. And so, not that there's anything necessarily inherently wrong with the stock market. So this isn't like a bash on the market there. I know a lot of you have made a lot of money in the market. You can make a lot of money in the market, but as you move and navigate the different stages of your life, there can be sometimes different ways, and in my personal opinion, better ways sometimes to diversify your wealth, reduce the ebbs and flows of the daily market risks, right? Create nice income distributions, and yet be in a place where you're still investing in things that have the opportunity for quality return. So what are your thoughts when you talk to investors or clients, families that we're working with that have come in, and really the only lens that they've had is the stock market's the answer? Steve?
Well, the reality is there's trillions and trillions of dollars that are moving off market. And one statistic that I always share with clients is, in 1996, there were 60% more publicly traded stocks than there are today. And why is that? The publicly traded world is demanding. You got to deal with shareholders, the stockholder meetings, dividends, the boards, you gotta show your dividends, which also affects the share price. There are a lot of things that you can't control in the stock market that affect the value of your investment. And realistically, if there's trillions of dollars moving off market, one of our methodologies is we're always looking for where money is moving. And if there's significant money moving off market, that's got to mean there's significant opportunity there.
Hey, Steve, let me jump in real quick. When you talk about that, I mean, that's an important piece, but this is just something that people have heard for years and years and years. I mean, if you really think about this, as you're looking at this and you think about the investment conversation that's had, I'm going to say in America, you could probably go globally, but the investment conversation, Nick, that's being had, I'm going to say in America today through the media outlets and print and books, et cetera, most of it is market centered. Most of it's markets. I mean, we wake up every day and people wonder, is the Dow up? Is it down? Is the S&P up? Is it down? And you see companies that are now, all the ETFs that are out there. So it's just come to the reality that sometimes this is the only game in town. And it's almost like being in a place where you go to Olive Garden or Outback or whatever, nothing wrong with those restaurants, but then all of a sudden in your area, there's a smaller boutique, 5-star Michelin, restaurant that kind of opens up, and you go there and you eat the food, and it's a 7-course pairing with all this wine that pairs well with the food. And you're just like, gosh, this is a completely different experience. And unfortunately, a lot of America do not live in environments where they have access to 5-star Michelin restaurants. So they just don't know, kind of ignorance is bliss in a lot of ways. And I think in a lot of ways, Nick, in relation to the markets, people say, okay, this is just what it is. And they just don't know where to go to find other great information. And for advisors that work for big, massive companies, they're well-intended, but the reality of it is, they have opportunities that they advise from. All the coaching they get typically is from folks that are in Wall Street sharing, here's what's happening, here's what's recommended, et cetera. And consequently, 80, 90, 95% of the portfolios a lot of times are market-based and market-driven. And quite honestly, it's the easier situation and story to talk about because now you kind of have an out. Oh, the market's up, your portfolio went up. Wow, we had a great day today. No, you didn't have a great day. The market had a great day. And just so happens you were tied to the market, so you made money. Oh, the market went down today. We had a rough day today. Or the market went down this last 3 months. We had a rough... And you're in a situation where you're literally tethered to something that neither you, your advisor, or the media in general can control, and you feel really out of control as an investor, instead of saying, wait a minute, time out. Let's go back to the basic fundamentals of business and think about, why are we investing in certain things fundamentally based on real business valuations and principles? And it's interesting because with the market, years ago, you got technical analysis, you got fundamental analysis, you get all this research that you can do around companies, but we have so many additional risks on the market today that we didn't have years ago. We got political risk, we got all kinds of global types of risks from war, all kinds of other things that really affect what happens today. Why do I say more than years ago? Well, the political risk scene wasn't as big as it was today. Why? As we're shooting this in 2026, because we have a neat little thing you've probably heard of called social media and the internet. And 25 years ago, the internet was not that prevalent. It was not going like it is today. So news didn't travel the way it did. And now if you have a small drop in a pond, it reverbs everywhere and people feel it. And then they comment about it. They talk about it. They share it, ultimately affecting this idea of what you're investing in, which is a stock market. It's a totally different game.
And a lot of times these things, these market moving situations are something as simple as, China posting on their X or their Twitter, we've come up with a way to make AI cheaper and faster, something just that simple. And then all of our tech companies take a dive, right? These types of, it's just, there's so much emotion on market investing that it's hard to create a long-term plan around it, right? And there's, you could talk more about the lost decade and things like that, but the predictability of it is very difficult when there's so much information out there and everyone has access to it immediately.
Well, and Steve, this is interesting because we talk a lot in the reality of trying to educate families and investors on things that they can do. We talk about the idea of the periods of loss or flat in the market. When you go back and you actually research the S&P 500, and instead of just saying, hey, it's averaged X% over the last 30 years, go back and look at the flat periods, right? Because what happens is a lot of times when people are working, they're investing into their future. You're adding money every month, right? Systematically into your 401k or your investments in general. Maybe you've had appreciated real estate that you've sold and you invest. So you're in a place where you're adding. So the ebbs and flows of the markets and the flat periods of the market don't necessarily affect you in the same way as when you retire. And when you retire, you're literally stepping into, I call it 30 to 40 years of unemployment, otherwise known as retirement. It's really the truth. And so that's why it's so important to build a plan that gives us the ability to have some more sustainability. Imagine being in a place where you work your entire life. I mean, just think about this as you're listening to this. Imagine being in a place where you work your entire life to build a portfolio, your wealth, and then take that portfolio and your income shuts off because you're not working anymore. And so you decide to take that monies and invest it diversified to the market, the stock market, which is something that no one can completely control. And you're literally taking everything you've worked your entire life for and you're investing it, and the returns are connected to an entity and a big structure that you can't control, that ebbs and flows, that has political risk and has global risk and has fundamental risk, interest rate risk, there's inflation risk. I mean, you have all of these different risks, and you're hoping that the rest of your life is going to be okay financially because of what's happened the last 30 to 40 years. Guys, here's the problem. The way people invest today, and the economy and the global risk and the inflation risk and the political risk that we are living in and experience today is different than what it was 30 years ago, which is why this conversation of this is what it's always done over the last years may not necessarily come to fruition. And you're taking income from the portfolio because you need to live, and you're in a situation where you have ebbs and flows. You have more health issues sometimes when you're older that you didn't experience maybe when you're younger. There's so many different factors that are different. And Steve, to your point, that's why there have been trillions of dollars of wealthy families removing their investments from the stock market and moving it more off market, quite honestly, which aligns very, very well with a lot of the things that some of the investment companies, if you will, that we use, utilizing quality off market investments that are well vetted, that put the client into an opportunity where they win, not just the investment itself, but they get the opportunity to win first. I think that's important.
Yeah, I mean, I think a lot of people need to break out the S&P chart and look at one of the most important factors on it, which was in the 1980s. And that was whenever 401ks became popular because companies could not afford to pay pensions any longer because people were living way too long. And what generation was that working in the 1980s? That was the boomer generation, the baby boomer generation. The biggest generation of people that had, at that time in the United States, all investing in their 401ks. And whenever you look at the chart, it was a significant uptick over the next 20 years. And it's continued to rise.
Well, they're adding fuel to the fire, Steve. I mean, money going into markets, it's like putting wood on the fire, right?
The baby boomers have retired, which what are they doing? They're taking money out of their portfolio.
Yeah, and then it's really the generation coming behind them and how are they doing to invest in their future and all that goes with that. And so, you see, I mean, listen, if you're a parent watching this, you know that your children are in a situation where their goal, they're trying in their 18, 19, 20, 21, 22, 25, 30, whatever, 35. They want to live the same lifestyle that they lived when they were with mom and dad at the home, right? So they're spending their money because they're used to a particular lifestyle on a lifestyle instead of operating under the lens of delayed gratification, which is preparing for the future. Now that's very different because there's less fuel going into the fire, but I think it still, brings back the reality to the point that it's important as we look at wealth, as we look at how wealth is invested. I think it's important to go back to the point that there are other things that you can do. Like the market's not the only game in town. That's kind of the point of this. So let's talk about some of the other games in town. And Nick, you've kind of had the opportunity not only assisting with clients along the way and families as the private tax director, but you've had the unique opportunity to see not only investment returns, real life returns of some of the families that, the sponsoring companies, Wall Private Wealth and others that we have worked with some of those families, but you've also seen the tax benefits of them. So talk a little bit about some of what you've seen real world on the backside, taking all the veneer off the front and looking at actually the actual returns as well as the tax benefits of some of these things.
So I don't think you can have a conversation or a comparison between on-market and off-market investments without looking at something called the tax-adjusted rate of return. Typically, you're investing in the stock market. If it's an income-producing fund, best case scenario, they're qualified dividends, which not all companies produce qualified dividends. If they're not qualified, then they're ordinary. And in places like California, where I'm from and where I live, people are, you can be paying as high as 50% on some of these things. So you think you're getting 7, 8, 9%, but in reality, after tax, that could be 5, 4%. Typically, when you're looking for tax efficiency and you're focused on on-market type opportunities, you're sacrificing rate of return for tax efficiency. What does that mean? We're looking at treasury bonds or municipal bonds, things that are technically tax-free, and whether it be federal or state, but you're sacrificing growth and income. You're at 3, 4, 5%.
I mean, let's think about this, Nick, real quick. People are like, hey, these feel safer.
Right.
The misconception here is that if you're getting a lower rate of return, it's a safer investment. That's not always the truth. I mean, think about municipalities. Just think about looking at muni bonds and going through and doing the research. If you own munis, maybe you've done this, maybe you haven't. Just go through and do a little bit of the research of some of what those munis are, the municipalities and the different things that you're investing in. And you'll find, think about how many local governments in different areas are fiscally, solvent and actually doing well financially. And you're saying, I'm going to take that bet because I get a tax break, so I'm going to go invest in that. I don't think it's that much safer.
No, I mean, you hear about it all the time.
Yeah, it's crazy.
Going bankrupt, right? Then what happens?
It can happen.
And that's one of the most common misconceptions is like, oh, I'm so conservative. I'm only investing in treasury bonds, or I'm only, investing in municipal bonds, thinking that you have a guarantee on your money, which you don't.
No, you don't.
You're both accepting a lower rate of return. They're not guaranteed. It's not like they're an annuity. There's risk of loss, just like anything else, or just like, any other type of investment that you're putting money into. And at the end of the day, where are you really leaving yourself? So that is why when we started working together years ago, I was, I come from a world of real estate in general, buying and owning real estate in your own personal name. And I was educated through your company, through your team, about these types of limited partnerships where they're paying a strong dividend along the way, but you still get to participate in what you would normally get to experience by owning real estate, which is the depreciation. The depreciation gives you paper deductions that allow you to extract value, extract income from the investment itself while paying little to no federal taxes. Some states conform, but at least on the federal side, with our clients, you're pretty much in that 37% bracket. When we're talking about rates of return, we're talking about true rates of return. Like I mentioned before, the tax adjusted rate of return on real estate and off-market investments typically is going to be higher for a similar risk profile.
Well, and a lot of times you may have heard it said, instead of tax adjusted, you may have heard it said like tax equivalent yield. It's basically the same thing. But Nick, the reality of it is you're in a place where you're saying, okay, because remember we were talking about one of the deals that families utilize where 60, 70, sometimes 80% of the income that actually is paid to the client is not taxed. I mean, that's strong, right? And then I know people talk about the idea of recapture at the end of the deal and all that goes with that tax, but there's a lot of things that you can do. The other thing that I'll say, it's so interesting, we've seen some advisors, this is a great way to kind of determine whether or not if the advisor that you're working with is elementary in his knowledge. That doesn't mean he's not a good person. That doesn't mean she's not a good person. But just how deep is their level of knowledge about what's really out there? You see a lot of times advisors will go and they'll talk about things like tax loss harvesting, and really talk about it like this is strategic tax planning. Yes, it's something you should look at, but it's not strategic tax planning. Or you have advisors be like, one of the best ways to kind of mitigate taxes on your wealth is to use a donor advised fund because it's a hot topic and something that people talk about. And Steve, just using those little strategies are great, but it doesn't mean it's right for everybody. And so unfortunately, there's often not a lot of in-depth planning. And I want to ask you, Nick, one more time from a CPA's lens, the importance of really thinking through. Again, you've seen soup to nuts, beginning to end, in a lot of ways, a lot of the investment structure on the other side as you've done returns that some of the companies that we've developed have helped families with. What else have you seen, that's out there? I mean, you talk about oil and gas, you talk about, there's a lot of other things that some of these investments sound too good to be true. It's not too good to be true. It's just, you're in a situation where you've never heard of it before.
Yeah.
I think that's the biggest thing.
So I want to address a couple of things. One, you mentioned recapture, right? Recapture is a component of depreciation. On an exit, there's a potential to have to recapture what those losses that you've taken over time are. Well, from our perspective, from a tax planning perspective, the name of the game is tax deferral, right? You're deferring taxes as long as possible. And in the eventuality, when those real estate projects do sell and you see that return of principal, that gives us the opportunity to do more tax planning, right? This is not a let's put something together in year 1 and then we'll forget about it until year 5. It's an ongoing conversation. Number 2 is the great part about especially the real estate side of the off-market investments is they are naturally tax efficient for the reasons that we mentioned, the depreciation. But there are also opportunities with effective tax planning where we can use that depreciation not just to maintain the tax efficiency of the investment itself, but also transitioning those losses from a passive type loss to a non-passive type loss. This doesn't happen by accident. This happens with careful planning and utilization of strategy that's been developed and battle tested over time, right? We're not doing anything that's crazy. We're not making up our own set of rules here. We're utilizing the tax code to increase something that is already tax efficient.
Yeah,
just making it more so.
I mean, listen, and Steve, I think that's one of the reasons in some of the financial companies that we have, obviously Wall Private Wealth, US Private Wealth, Wall Private Capital, some of the other companies that power this show, and then just having this conversation is, in those companies, 100%, almost 100% of the clients, families that we work with there are referral. I mean, that's not by accident. It's by families over time seeing quality results, quality returns, quality tax saving, right? And saying, you got to talk to this person and that person and this person. And I think that's a big deal. And so when you're in a situation where you're looking at your portfolio and you're looking at your investments, we're talking again about this idea that the market is the only game in town. I think you have to strongly step back and say, well, time out. Just like there's many industries. Now, I know that you can invest in many different industries on market, but there's also a lot of different industries that you can invest in off market. And anytime you're investing, by definition, there's some type of risk that you're taking. I mean, that's just the way it is. By the way, even if you take your money and you put it under the mattress, or you put it in a CD, certificates of depreciation, that's my term for it, or you take your money and you put it in a money market account, you know what you're doing? You are literally losing money safely. Why? Because you're not keeping up with inflation. So at the end of the day, we know that the buying power of $100 today is not the same as what it was 30 years ago, or 20 years ago, or even 10 years ago. We know that the buying power of $100 in 10 years is not going to be the same as it is today in 2026. So when you think about these things, the goal is to get your money moving forward, right? Not just put it in an account that makes almost nothing as far as the rate of return. The challenge, however, is what can you do to diversify your risk and put yourself in a place where you can at least mitigate risk that the market doesn't have. So what if you could say, all right, there's 10 risks that I could experience in my investment career. One might be inflation risk. Another one might be interest rate risk. Another one might be political risk. Another one might be fundamental type risk. Another one might be technical type risk as people are trading in the market. Another one might be, who knows? I mean, there's all kinds of other risks that we can face. So what if you said, okay, somebody sneezed in China, stock market risk. Somebody sneezed in China and we have social risk of people, oh my gosh, we got to sell this company. Yeah, panic because they subscribed to this and they did whatever, and there's a lawsuit pending, or somebody, was accused of XYZ, and then all of a sudden 3 months later we find out that none of it was true. But in the meantime, the stock or investment that you owned on the stock market took a bath. You lost a bunch of money and you're in it. So you're like, I can't just get out. So what if we could literally look at investing through the lens of like, all right, what if there was a way that we could eliminate social risk? Would that be a good thing? I think it would. What if there was a way that we could eliminate political risk? Would that be a good thing? I think it would be. What if there was a way that we could eliminate interest rate risk? Would that be a good thing? I think it would be. Now, there are some risks that we can't get away from. We have to do research fundamentally on the investment and so on and so forth. But the goal in looking at quality off-market investments that are client-centered. What does that mean? That means the client wins first. In other words, the clients have the opportunity to make money before the developers and the deals and the ones running the deal itself are making money per se. In other words, the clients put first. That's important. And by doing these things off market, we're literally taking more control, believe it or not. It feels like to some investors initially that we're taking less control because it's new, right? But we're actually taking more control over our investments, and we're actually eliminating several risks that I just mentioned: interest rate, social, political. We're eliminating some of those risks. We can't eliminate all of them, but if there's 5 or 6 or 7 or 10 big risks, if we can eliminate 3 or 4 risks or 5 risks, that massively increases the opportunity to outperform year after year after year. Nick, you were going to say something.
What my favorite type of risk is the tax risk, right? Because it's something that is true in any it's 90,
not your favorite. It's your favorite to get rid of.
Well, let me tell you why it's my favorite. It's my favorite because the IRS literally provides you with a playbook of how to mitigate, how to defer, how to minimize. And that's what we specialize in, right? There's a guidebook to it. Can we plan for if country A is going to bomb country B? No, but what we can do is be smart with our investment decisions and then being proactive with planning around them and minimizing that in the long term. We say it all the time. The biggest risk to your net worth and long-term growth is paying taxes every single year. So why shouldn't that be on top of mind? Yeah. It's one of the few risks that we have a lot of control over because of the playbook the IRS gives us.
It's a great point, Nick, and that's exactly why, listen, as you're watching this or you're listening to this via podcast, you got questions, you're like, gosh, these guys are making sense. I don't know exactly how they do what they do. I don't know how they make the donuts, but it sounds like they make them and they taste pretty good. I'm going to challenge you to reach out. Head over to leanonthewall.com. Leanonthewall.com, and there's a form there. You can fill it out. You can connect with a team member. We've had a lot of family offices that are looking for great strategy to add into what they're doing. We're happy to help and sit down and have a conversation. But these are all things, Steve, as people head over to leanonthewall.com to learn more about us, that it's a proactive process for them to take a step of saying, I want to actually go down the path of improving. And I think that's what happens sometimes is people just get comfortable, like the frog in the pot with what they're doing, and they don't make changes until it's too late.
I mean, at the end of the day, recessions suck, but recessions suck much more whenever you're retired and you're constantly liquidating your portfolio while the market's down to achieve what you need. It really is a big deal. I think to wrap it up, we work with a great family. He was a executive at a publicly traded company running a multi-billion-dollar division within that company. And the other companies within that publicly traded company were ruining the share price. They were making poor investments, but in his division, he was making good acquisitions, good business decisions. The company was growing and really leading the charge. And he got sick and tired of the publicly traded market dragging down the share price of the entire company. So he said, you know what? I'm going to go to a company that is in private equity that's not publicly traded so that the good business decisions that I'm making are actually going to showcase themselves in regards to the success and the money I'm getting paid, from owning shares in this.
Well, Steve, that's exactly what we're talking about here. We're talking about the idea of taking more control of your portfolio. Imagine being in a place where instead of going to have an investment meeting, right, with your advisor on the regular basis, and Nick, your advisor's like, hey, you know what? The market did really well. We had a really good year. Awesome. Great. That's amazing. Oh, you know what? The market did poorly. We had a horrible year. Or imagine being able to take some control. You say, okay, it doesn't necessarily matter whether the market did well or did poorly. We have the ability to control more of the type and quality of investments that we're getting in. Consequently, years where the markets are negative, you can still find significant opportunity off market. Imagine being able to have that much greater control over your investments. Not only does it feel good in the moment because you're kind of evening out the ebbs and flows, emotions of the market, but you're in a place where you don't have to sit there at night, God forbid something happens, and you're worried like, oh my gosh, there's another war or something happened, and the market drops X percentage, and your mindset, because you're all in the market, is, gosh, my portfolio is taking a dive. You're literally in a place where if you transition to different planning, which is what we've done for years and years and years for families all over America, you're in a place where there is no perfection, but there is progress in the fact that you're looking at things that are reducing your risks beyond just all the risks that the markets face. Again, there's risks in everything that we do, but we want to mitigate and try and eliminate some of those risks. And as you pointed out, Nick, some of those risks are tax risks in addition to all the other risks we talked about, and it's the biggest one. I'm going to give you the second to last thought, and I'm going to land the plane.
I just wanted to bring up a situation that, just today we had a meeting with a newer client, someone who's been in the market traditionally for the last 60 years. He's an older client. That was all he was ever familiar with, but he was referred by another family who knew what we were doing. And we've been working with this guy for 6 months now. And it was just really humbling and nice to hear today when we were doing his investment review, talking about not only the cash distributions that he's been able to realize from these investments, but also how when we were going through his tax return right before we're getting ready to file here, how even though he's pulling out more cash and making more money, he's actually paying less money in taxes, right? And he was just taken aback. The guy is in his late 80s, early 90s. I don't remember exactly how old the guy is, but it's just my point is it's never too late to have a paradigm shift, right? Just because you're used to it doesn't mean that it's the only or the best way to do it.
No, I think that's a great point, and it's kind of the proof is in the pudding, right? I mean, we're not talking about ideas that don't have real practical application, which is one of the reasons that a lot of our business, we're very, very heavy and high in referral, and clients refer, families refer people to us. We have some great families that we've been able to work with for a long time. Listen, I just wanted to take some time here to talk about this. I understand as you watch this, you say, obviously you're talking about this because you guys have financial companies and you're in a situation where you're probably looking to get new business. And I would say to that, you're 100% correct, right? At the end of the day, I mean, if you believe in what you're doing, you want to grow and you want to help more families. And that's why we do what we do. I mean, that's really what it is. And so we've seen a lot of great success over the years. We figured out, I've taken a lot of time over the last 26 years and learning a lot of things that has enabled our team, some of the folks that you're seeing here and others, to not only develop, create, put together, just an investment structure that's a little bit unique. It's different than the norm. It's different than what a lot of firms out there see. And we're able to do this in such a way that brings to the table quality for the families we serve. And as you're there, I understand what it's like to be in a place where you feel like maybe you're helpless, in a lot of ways. You're worried about the ebbs and flows of the market. You're worried about all of these things that are happening in other countries and wars and things that could happen and occur. And so you really are in a place where you can kind of feel helpless. Well, I'm going to challenge you to take the reins of control back and think about doing something that might be a little different with your wealth. So as you're listening to this, if you have significant wealth, reach out to the team, leanonthewall.com, and see what they have to say, what they have to do. Obviously, we put this InvestWell show together. We talk about a variety of different topics, but it's powered by the Wall companies. And the reason that is because we've done a great job of helping families. So I hope that's given you all a little food for thought as you've watched this or listened to this to think differently. Whether you decide to reach out to us or reach out to the team or not, my challenge to you is to educate yourself. Ask questions. Be curious. Think about how you can do things differently. Think about, is what you're doing now the best thing, not just for you, but also for your family? Think about ways that you might be able to say, you know what, I would like to take a little bit more control and reduce some of the external risks. And if there's ways to do that, I'm going to take some effort and make some effort to actually find out what that is. My challenge again is to stay curious, be intentional, and make better decisions with your wealth. See you next time.